So if we now have an economy in which we see job growth, finally, we see housing and durable goods and other sectors of the economy really improving, and yet we don't see a whole lot of inflation at the moment, what can the U.S. government do? What are the choices that they have? And let's start first with so-called monetary policy. That's what the Fed does. It regulates the money supply. What I'm showing you here is simply interest rates. If you've ever seen a yield curve, this is what it looks like. On the left to the right, what you're looking at is different maturities of treasuries, from 1-month T-bills to 10-year treasury notes, all the way out to 30-year treasury bonds. And going up, the vertical axis is simply the interest rate or the yield. A year ago, last May 2013, the green line was where interest rates were. And in the course of the past year, interest rates did drift up somewhat. They went up a lot and then they came back down. The purple line is where they are today. And you can see that for a 10-year note, for example, the interest rate has gone from under 2% to about 2.5%. For the 30-year note at the far right edge, it went from about 3 to now 3.5% or so. The question is, if the Fed stops buying long-term bonds, what happens to this interest rate? That is to say, what happens to the yield curve when the Fed is no longer an active player in the market? Our expectation is the orange line. We've looked at the relationship of interest rates to economic growth and inflation and other factors, and our best guess is that the orange line is where we think interest rates ought to be, all else being equal. Now, I don't think we're going to get to a 5% 30-year note, 30-year bond anytime soon, simply because of the international issues that I discussed earlier. But again, that's only from 3% to 5%. That's only a 2 percentage point change, and that can wipe out 30% of the value of a 30-year bond. So that is a huge move in price and value. If you come back to the 10-year, do we think it can go from 2.5%, the purple line today, to 4%, where it pretty much ought to be trading? Well, maybe not all the way, but we could see the 10-year note as high as 3.5% sometime late this year or early next year. What does the interest rate mean now as we switch over to the federal budget and the fiscal side of government? That is to say, what Congress does. Over the past few years, the U.S. government debt has ballooned from $5 trillion in 2007 to $11 trillion in 2012, and now it's up to about $17 trillion. As a percent of the economy, it's grown dramatically. But look at the second line there in blue that says debt service cost. The cost, the interest expense that the federal government paid on that debt has barely budged because low interest rates have really, really helped the federal budget. What's going on here isn't simply that interest rates are low now, it's that they were high earlier. So those 30-year notes that were issued when we were talking about 10 and 12% treasuries, those are coming due now. And so we're replacing, the federal government is replacing 8 and 10% money with 2% money. As that continues, and it will continue for some time, the debt service, the cost, the ability of the Treasury to pay for its debt continues to improve. So I'm not worried that we're going to have in the near term any kind of interest cost or deficit or debt crisis. The national debt at current interest rates is very manageable. The Treasury will continue to refinance more expensive old debt with much cheaper new debt as that comes due. And so we'll be seeing interest expense for the federal budget continuing to be pretty low for some time to come. But what isn't going to stay low, and isn't low to begin with, is the entitlement part of the federal government. And here I'm talking about Social Security and Medicare and Medicaid. So this is a complicated chart. If you look at each set of 3 lines, the bottom was the past 40 years, average per year. The middle is the last full fiscal year. And the top one is what the Congressional Budget Office thinks will be the case 10 years from now. And the top line of each setting is simply revenue or income to the federal government. Most of it is green, that's taxes. And a little bit is the deficit, that's the red part. The next line, the middle line, with lots of small pieces, is what the federal government spends money on. The pieces that are highlighted with a black bar under them, those are entitlements. They do not need new laws to spend each year. They will be spent unless laws are changed. The blue is Medicare. The brown is Medicaid. The yellow is Social Security. Those three have absolutely bloomed. They've just grown tremendously as a portion of the budget and are expected to continue doing so as we as a nation get older and live longer. On the other side, the parts that are highlighted in green there are discretionary. That's the parts that Congress has to make a new law each year to spend on. The more orange part is defense, and the sort of lightish greenish gray is non-defense. That would be everything from medical research to roads to office buildings to whatever else the federal government is going to spend money on. And what you can see pretty clearly is that the entitlements are squeezing out everything else. So where defense was 6% of our economy in 1973 to 2012 on average, we think that's going to come down to only about 2.5%. In other words, we will be trying to maintain a military on less than half the budget that we did previously. And we will be spending less than half as much on everything from medical research to schools to student loans to all sorts of other government programs that exist. It is very difficult for me to imagine 10 years from now how the government will be able to do so. You can see, by the way, that interest expense, which is the brown item, has come down and isn't really going to grow a lot more in the next 10 years, even as the deficit grows. So the real issue is, how can the federal government reduce those entitlements as a percent of the economy? There are some ways to do so with higher taxes. There are some ways to do so with lower expenditures. That is a long-term issue that must be addressed, and it's very difficult to get Congress to do that. So let me wrap up. What we've talked about so far is our philosophy of how to invest, what we think the guiding principles are. Then we looked at how the markets are acting today and where we think opportunities lie, and how we would want to tactically adjust portfolios from their strategic neutral point to reflect what current market conditions are. And then we talked a bit about how the U.S. economy is acting and why the economy leads us to the conclusions that we have about where we want to be investing. And then I just touched briefly on some economic policy choices to put all of that in context. But to sum up, remember, money is a tool. The question at hand is how to invest it wisely to accomplish what your personal goals are. And if you can do that successfully, then you've done very, very well for yourself. So I'll stop there. I thank you for listening. My contact information is on the screen. Feel free to email me or to call me, and I'll be happy to talk with you. Thanks very much.